Hello, and thank you for listening to my talk. I'm Catherine Greene, and I'm going to talk about what finance can possibly teach us about social ontology. I feel like a bit of an interloper in this conference because social ontology is not my field. My background is in philosophy of social science and finance, but in reading around the topic a little bit, it struck me that finance might be an interesting example for some discussions about social ontology. Whether that turns out to be true or not, I'm sure I will find out at some point in August when we have our discussions. So we are going to begin with a digression into finance, and then we'll return to ontology in the second half of the talk. But to give a brief introduction to what I'm going to say, I'm trying to approach social ontology from the perspective of practical social science, following Little's suggestion in his most recent article. And I think that finance is a relatively good example of a social science. And I think that it provides some useful and interesting insights, because when we're dealing with financial markets, what's out there in the world depends on who is doing the looking, and importantly, with what purposes they're looking. So the same thing can be seen very differently by different groups of people. So onto the finance introduction. What's an equity? So companies list their shares on stock exchanges, and these shares are called the equity of the company. In the olden days, if you bought shares, you'd get a piece of paper confirming that you'd bought a small portion of a company. These days, you no longer get bits of paper. But it's still true that if you buy shares in Excellent Widgets, for example, you own a very small part of Excellent Widgets. Investors buy these shares in the hope that they'll make money if the price of these shares goes up. So suppose that you think that Excellent Widgets will do well over the following year. So you buy at X dollars per share, and Excellent Widgets does do well. Let's suppose it sells a lot more widgets, manages to raise the price, makes higher profits, and the price rises to 2x per share. You can sell and make an extremely good profit in this case. This is a fairly simple example of why people buy equities, and it doesn't really tell the whole story. Not all investors buy shares hoping that the value or the price of those shares goes up because they're optimistic about the underlying company. Now, that sounds slightly strange, and I'm going to explain it in a little bit more detail over the next few slides. But listed equities are also financial instruments whose price can be affected by a variety of other factors. And the prices at which these equities trade tell investors, or give an indication to other investors, of what other people in the market are thinking. And people need to not only understand Excellent Widgets, but make sense of what's going on in financial markets more generally. So, are there reasons why you might buy Excellent Widgets? One, you might expect an increase in global demand for widgets. And in this case, you'll buy our company, Excellent Widgets, but you'll also buy lots of other widget manufacturers out there in different countries. Secondly, you might be expecting a currency devaluation in the home country of Excellent Widgets, in which case you wouldn't just buy Excellent Widgets, but you'd buy a whole basket of companies that export, so as to take advantage of the currency devaluation. A third reason could be that the price of Excellent Widgets shares have moved out of alignment with the share prices of other companies in the same sector or other financial instruments. This is called statistical arbitrage, and a large number of investors do pursue these sorts of strategies, where they analyze the statistical relationships between equity prices and other financial instruments and trade on the basis of that. The fourth sort of reason could be that evil hedge funds have shorted Excellent Widgets. That means that they've sold the equity of Excellent Widgets on the hope that the price will go down, at which point they'll buy their shares back and make money. As in the case of GameStop, if you get the story out there that evil hedge funds have shorted Excellent Widgets, and you get enough people behind you, you can all buy shares and hopefully cause the price to go up, thereby potentially causing a loss to the evil hedge funds. There's a name for these sorts of trades now, and they're generally known as meme stocks, where ideas are spread usually over the internet and trading chat groups and that sort of thing. Now, the worry or response that people might have to these 4 reasons is that reason 1, increasing global demand, and reason 2, based on macroeconomic factors, currency devaluation, will over time lead to an improvement in the fundamentals of excellent widgets. For example, in scenario 1 or 2, you might expect their profits to increase, the profit margin, their sales to increase, etc. But it's important to note that generally the share price will move before there is an effect on the underlying company itself. So you can make money by trading on the basis of reason 1 or reason 2 and sell your investment and make money before you see an actual improvement in excellent widgets, earnings or profits, etc. So all those first 2 reasons for buying the shares are related to the performance of the underlying company. It doesn't necessarily need to occur in order for you to make money on the basis of those reasons for buying the shares. So to conclude this slide, investors don't only buy shares in excellent widgets because they expect the company itself to do well, but they may also buy it because those shares are a financial instrument that can give them exposure to a variety of other things, such as global demand and supply, macroeconomic factors, statistical relationships, or meme stock type things. So it's not necessary that an investor buying the equity of excellent widgets has a particular view about excellent widgets at all. They're buying for different reasons. And in many cases, they might actually not care about the company that much at all. The equity represents a payoff to a number of factors, which we've gone through: exchange rates, correlations with other equities and financial instruments, macroeconomic factors, or just wanting to annoy other investors, such as hedge funds. So equities are financial instruments in addition to representing a partial ownership of companies. So what on earth does this mean for social ontology? Here's a quick summary, and I'm going to hopefully convince you of some of this in the next few slides. So the ontology that investors have does match up in some sense with what's out there in the world, with the joints in nature, to use the horrible phrase. But financial instruments can simultaneously be many different things, depending on the perspective and purposes of different investors. And investors' beliefs about the world, i.e. their ontology, affects the actions they take and what counts as empirical success. Now, in the literature, empirical success seems usually to be understood as prediction and explanation. And I'm going to try and suggest that I don't think that that's the whole story. So, does nature have joints? Does our ontology match up with that? Well, yes and no, I think, looking at the case of finance. Equities do represent ownership of companies, and this is always true of equities. So our ontology seems to be matching up with what there is out there in the world. However, the other things that equities can be are more disputable. So investors do agree about what equities are fundamentally, and this seems to match up with what's out there in the world. But there can also be all sorts of other things, ontologically speaking, returns to macro changes, ways of playing, statistical relationships, etc. So this suggests a modification, in my view, to Little's view that there are multiple descriptions of things in the social world. I think that's true, but an individual investor can believe that multiple descriptions are true at any one point in time. So it's not necessarily the case that an investor only has one ontology regarding a single equity. They might believe it is 1 or 2 or even 3 things at any one time. It is a partial ownership of a company, but it is also a way to benefit from macroeconomic changes, for example. Now, as well as equities representing ownership of companies, the price at which equities trade is also out there in the world and seems to be matched quite closely with our ontology. We think that there are prices of equities, and they are quoted. We can look them up in various ways. These prices that an investor sees is something that they have to make sense of and decide how to interpret. So suppose they're interested in looking at excellent widgets. They need to ask themselves, why is the share price going up or down? Which is another way of saying, how are other investors viewing this equity at this moment? The stereotypical view of equity analysts is that they sit there plowing through reports and accounts, meet management, sort of sit in a little isolated room, working out what they think about a particular company. And although that might be true, a large part of that is also looking at the market and trying to make sense of why the share price is moving in the way that it is. Sometimes it has nothing to do with what's in the report and accounts or meetings with management, but there are structural things that can be important. For example, if a company is about to enter an index, its share price usually rises in advance of that, on the expectation that people who follow the index will be required to buy this equity at the point it goes in. Sometimes investors just need to rebalance, and if they're large investors and people know about this rebalancing, they know that they will buy and sell certain things over the next few weeks, and other investors can trade in advance of that. Similarly with forced sales, if a big investor is going out of business, a big hedge fund, for example, it will affect prices, and smaller investors will try and capitalize on that. So investment decisions are rarely made in a vacuum. And the point of this slight digression is to suggest that once you know what you think about what's going on with equity prices, you can decide what to do. So I'd like to try and make the case that having a successful ontology, or correct ontology if you prefer, isn't just about prediction and explanation. It allows people to determine what action they should take. So our ontology frames what we do and the stories that we tell about what we're doing. So it's not just about making successful predictions, but convincing others of your story, which in finance at some point down the road will hopefully lead you to making money. And an investor often has an active role to play in ensuring that their prediction of their story is right. Most people have heard of Warren Buffett. He is a very successful investor who is quite keen on sharing his opinions about various companies. And a lot of people read his newsletters and commentary on different companies. Now, you can bet that the companies he talks positively about are ones that he has already bought. So in thinking that Warren Buffett is a successful investor and perhaps following some of his suggestions about what to buy, we are actively making him a successful investor, because if enough of us do it, then the prices of what he owns will go up. So this makes it slightly difficult, in my view, to say what we mean when we say approximately true and empirical success. So it's possible, I think, to argue that empirical success also has something to do with enabling us to make sense of what we see before us, specifically equity prices, determining a course of action, and helping to form some sort of story that hopefully others will agree with, and which then lead them to behave in the same way that we have. So it's not so much about reflecting, or ontology reflecting, what is out there in the world, but reflecting other investors' future beliefs. And after all, in investing, an investor who does nothing is not a successful investor. You can't make money unless you take some action. So in many ways, I think I've probably approached social ontology the wrong way around. Most of the papers I've read write about ontology and then discuss an example or two. And I've begun with an example and asked how it relates to the literature. And is this legitimate? I'm not sure. But as I said at the beginning, I'm sure I will find out in August when we have the Q&A. If it is legitimate, I think that finance suggests some issues in the social ontology debate are quite complicated. Does our ontology cut nature at the joints? Yes, but investors also have a role, I think, in creating new joints of nature or new interpretations. And perhaps more importantly, I think there's a case to be made that empirical success isn't just about prediction and explanation. A successful ontology, or having any ontology at all in some cases, is also a means to allowing us to decide what to do and convincing other people of our ontology and our interpretation. So specifically, an ontology allows us to decide what to do in the face of uncertainty. And part of this is persuading other people to see the world in the same way and to share our ontology. Thank you very much. And I'm looking forward to the discussions in a few weeks.